DriveWealth is a great example of embedded finance, specifically on the investment side. We don't talk a whole lot about investing here. We focus primarily on payments and banking at Tearsheet. So investing, hello, John, doesn't necessarily get its fair share in the sun, but very excited to hear what John has to say. Welcome back, John.
Thank you, and thanks so much for having me. It's great to be here at the Big Bang Theory podcast or conference rather, and I'm really excited to get back on a stage and talk to you all today about some really interesting things in the world of investing and how they can be presented so much differently depending on different demographics around the world. And so first of all, a little bit about DriveWealth and who we are. We're a pioneer in fractional investing and embedded finance around the world. And we power a lot of incredible brands like the ones that you see on screen here in bringing investing to their audiences. And over my time here at DriveWealth, I've been able to work with not just some phenomenal financial brands like these, but I've also been able to work in many, many different regions around the world in shaping how customers in those regions think about investing, think about finance overall, think about money. And so again, what I'd like to show you today is a little bit of how we take those investing products and shape them differently depending on the audiences that each of these brands are uniquely targeting. Over those last couple of years at DriveWealth, we've seen this really incredible growth in retail investing, meaning non-professionals who are getting into and engaging with the stock market. And so you'll see on screen here that the current percentage of stocks that are traded by retail investors, non-professional investors, it's about 20%. And that's actually double from where it was just about 10 or 11 years ago. So there's been this real incredible trend and uptick in, again, these retail investors getting into the market. And this is actually occurring all over the world. This isn't just specific to the US, but there's really more eyes than ever worldwide on investing. And a lot of that is thanks in part to some of these brands bringing investing to their customers in, what in many cases is this incredible embedded offering that is now pairing investing with banking services, lending services. Even we're seeing, e-commerce companies, for example, start to pair financial services like investing with that offering. And what's really critical is that as brands like that look at globalizing investing and bringing investing to new audiences or taking investing from one region into another, we have to have this really deep understanding of how different cultures interact with financial products. And what we're going to be looking at today is how different factors like where somebody's located or cultural differences, maybe how much money they have, how all of those different attributes really shape what they're expecting out of a financial services products. And there's some really unique ways that applies to investing that perhaps don't apply when we look at a different aspect of financial services like banking. And I'll start with kind of a short example here. When you see stock tickers presented on apps or TV or different newspapers, they all generally look something like this. We have, one stock here that's up on the day. We have another stock that's down here. But in actuality, when we look around the world, it's not as consistent as just this. In fact, in many other countries in the world, the colors used to represent those two things, stocks moving up and down, are totally different. And so, for example, in much of Asia, red is a very lucky color. Red is a very positive color. And so we see in countries like China and Japan and Korea that red is actually used to denote a stock moving up and green is used to denote a stock moving down. And looking at, material and educational information from one culture alone wouldn't really tell you that. But this does change as we look around the world. And, this is just a small example, but there's so many topics like this that are shaped by geography, by wealth, by age. And, we really have to think about those things when we're designing investment products. And, this goes for things like, how do we educate customers, right? How does that change as we look around the world? Or, maybe if we're building a stocks trading product, what public companies are going to resonate in one country may be very different from another country. And sometimes we even need to look at the broader feature landscape and are there total feature differences between what we want to present one customer and another? There may be certain account types or security types that make sense and are expected in one region, but not elsewhere. And so taking a very global look at the world, I like to split up geographies into three main buckets here. And we're going to talk about all three of these today and some uniqueness in each of these regions. But we'll start with some larger established financial markets on top. And then we'll talk a little bit about some smaller markets that are just as financially sophisticated, but smaller by population. And then finally, we'll touch on some developing markets and how the needs of those customers can be unique and different from the other two. And so we'll start here with some larger markets like the US and the UK, for example. And in these markets, there's a lot of phenomenal access already to investing products, both in quantity of financial services providers and also in product choice. There's a lot of different products that we as investors can engage with that handle money in different ways. And so because of that, in these markets, investors are generally looking for making that experience more and more frictionless, hence that embedded trend, right? And they're looking for how can we simplify that decision-making process for somebody either getting into investing or as they continue their investing career. And we'll take a look a little bit at how different financial brands have shaped those expectations over time. And so over the last 20 years or so, if we start with, for example, E-Trade here, one of the first brokers to bring their investment services online, this was just the start of sort of a whole revolution in digitizing finance and, really completely altered how investors interacted with the market, right? And you certainly didn't need to call your stockbroker anymore to place a trade or, wait for a statement in the mail. We can all do that online now, right? And E-Trade was one of the first companies to bring that to its customers. And then a couple of years later, in the 2010s or so, we saw the rise of the Internet Advisor with companies like Betterment and Wealthfront. And I call attention to that here because it really showcases diversity of product choice that a market like the US has access to. And the launch of services like this gave customers who, maybe weren't comfortable being stock pickers, but still wanted to have some degree of control and support over their wealth, a new type of tool that perhaps that customer didn't have access to before. And then a couple of years after that, we saw the rise of applications like Robinhood, which dramatically changed the cost profile, right? And it actually took away the cost barrier for a lot of people. There were certainly investors who were starting with a small amount of money, didn't necessarily have a lot of capital where they felt comfortable paying what were the high commission costs at the time. And so this really further broadened the accessible user base. And it's companies like these that have been fueling what we saw before, that rapid rise in the retail participation. We can really thank companies like this for supporting that. And fueling that participation even further, especially over the last couple of years, has been this push into embedded investing and embedded brokerage. And we see that with apps like SoFi, for example, that are putting investing alongside so many other great financial services. And in certain circumstances, many apps launching even non-financial services like e-commerce launching investing now as well. A huge part of the success of all these different companies and many more here in the US has been that at each of these phases, each of these timeline steps here, they've been continually redefining what does the general investor want out of their investment experience, right? What are they critically looking for at that point in time? And what I'd like to do is look at a more traditional broker here for just a moment and look at what it takes to go and purchase, in this case, a stock at a more traditional firm. And notice how on the right-hand side of the screen here, there's a lot of very opaque decision-making processes that I have to go through as an investor. So I have to come to this screen and I have to look at something like order type and decide, do I want to market, a limit, a stop, something else? I have to look at things like that time in force on the bottom. Do I want a day order? Do I want a non-close order? And the way this is presented, it sort of expects or requires that you as an investor not only have enough information to know which of these options you want, but also that you probably want to know what each and every one of these things do. Because if you get to the screen, maybe you know what a market order and a limit order is, but you don't know what the other two are, that can really hurt your confidence. And that can really throw you off and make you, second guess, am I making the right decision? Am I choosing something that's inappropriate? Is there a better option for me? And so interfaces like this sort of have this challenge where for a general investor, somebody who doesn't work in this industry, maybe is a little less financially savvy, again, it can really hurt their confidence and their adoption of these products. And when we contrast that to one of the brands that we just saw, in this case, Robinhood, for example, That screenshot on the right here is doing exactly what we just saw. We're choosing an order type when we're going to purchase some stock. But notice how differently this is presented here, how much more conversational this is, right? We have all the same options and some more actually, but we have little descriptions of what they do, right? We have little illustrations of how they work. You can tap these and get some more guided material on how they function and what you should expect. And I think this is a really good example of recognizing the needs of their specific audience and realizing that we'll have customers that get to this step that, again, maybe don't know what 3 of these 5 do, but now have the material interjected where they can go and learn and feel more confident about progressing with this behavior here. And so ultimately, it's product decisions like this in the US that continue to widen the accessible audience here, make investing more approachable and much more attractive, especially for newer investors who are just starting on their financial journey. And so while in the US, we're really focused on taking away barriers, like making it more frictionless and simplifying the decision-making, again, there are other barriers like cost that are generally removed from that equation. But that doesn't necessarily apply when we look at some smaller markets here. So when we focus on, for example, we'll pivot to Australia and Singapore on the left side there, there's barriers like costs that are still very, very prominent and that we really need to address when we look at launching products in those regions. And because those countries are so much smaller, there's also some interest in other features like international exposure that don't necessarily exist in a market like the US. And I really like the use case of Australia here because it is a very educated and sophisticated market. If we look at a poll done by the Australian Securities Exchange just about a year ago, they found that more than 1 in 3 young Australians were intending to buy international shares over the next 12 months. And this is just totally mind-blowing to me because we're talking here about Australians that are financially savvy enough not just to recognize they should be investing, not just to recognize they should be buying stocks, but also that they want to diversify and look outside their own border, right? And they recognize the importance of that. As a reference point here in the US, it's estimated that only about 1 in 3 young Americans own any stock at all. And so to me, it's really clear that in Australia, the investing culture, the investing appetite is really deeply ingrained, and it's ingrained from a very, very young age, which changes the way that we may potentially talk to this audience. But interestingly, when you look at a traditional broker in the Australian market, a product like that, an international shares product, actually carries very, very high costs in relation to the rest of the world. And so here, for example, you may be paying anywhere from 20 to 30 or even more US dollars every time you want to make an investment. And so it's somewhat ironic to me that you have this product, this international stocks product, people wanting to buy Apple and Tesla and Google and names like that with such a large audience. You have so many people in Australia that want this product, yet the cost barrier is still there and the costs at many firms are still so high. You have these real competing forces there. And so that's why when you look at a challenger Australian broker, for example, a newer entrant into the space, you'll see them often lead with 2 things. You'll see them lead with the cost and how much more compelling that may be than other providers. And you'll also see them lead with that international access, right? That international shares product. And these 2 things are really 2 factors that you won't see, for example, a US firm advertise very heavily anymore, right? It's very rare to see a US broker talk about commission costs because there's just this expectation that it's zero or very close to it. And there really isn't much appetite for international shares here in the US, and so you'll rarely see a broker talk about that either. And so again, sort of same product here, in both of those markets, we're talking about trading these large international names, but presented in marketing materials very, very differently. And then as we look at some developing markets, so if we look at countries like India or parts of Africa, parts of Latin America, the needs change again. And there's a whole different series of expectations that investors in these markets have. And a lot of times in these markets, we're contemplating things like liquidity. We're looking at things like the safety of someone's assets. And we're also very critically looking at how do we educate customers in these regions in ways that may be different from these other countries here. I like to take a look at the use case of India. And in India right now, it's estimated that only about 3.7% of the population invests in the stock market. And this is a really, really low number. This is low even for a developing nation. If you look at, for example, China, similarly sized developing market, they're at about 12% participation in the stock market. And so again, this number is drastically low. And there's a number of reasons why, there's a number of theories of why this hasn't perhaps accelerated as much as we've wanted over the course of the last couple of years. But I look to SEBI, the Securities Exchange Board of India, as to why. And they really point to education. And they point to the fact that there is this cultural challenge where a lot of Indian families still see investing as akin to gambling. And so when we look at a market like India or many other developing markets, we have to solve this educational problem in order to increase that adoption at all. And we have to educate customers on financial choices that aren't as risky as gambling, right? And how to use these services in a way that is not just important for personal wealth building, but in certain circumstances, very critical to fighting local challenges like inflation, which could be very different around the world. And so for this reason, when you look at now an Indian challenger firm, an Indian challenger broker or a newer entrant here, you'll oftentimes notice that they're leaning very, very heavily into education. And they're creating as much material as possible up front for Indians to learn about the market, about the financial services that the firm offers. And they just kind of have this entire library of content, oftentimes right on the homepage, before you even open an account, before you have any relationship with this firm, all in hopes that they can essentially preload that customer with the confidence and the material that they need in order to get started on their financial journey. And what I find interesting about this is that this model of sort of front-loading customers with all knowledge and waiting for them to go and consume it, it's had very limited success outside of the Indian market. When we go back and we look at, for example, the US, I have an example here from Public where an investor has gone and looked up a stock that maybe is a little riskier, maybe there's some volatility. And notice how in this case, the way education is tackled is that, again, it's interjected into what the customer is doing. There's almost this expectation in this case that a customer or a certain segment of the audience could have gotten to this step without yet knowing this, right? Without recognizing what investing in a volatile stock could mean for their gains, losses, their portfolio as a whole. And I actually really love this model of learning by doing and guiding the customer throughout their experience. I think this is a phenomenal model for adoption and for keeping that confidence in the customer as they progress. But this model where we're, sort of learning by doing and handling that customer, it's just not appropriate. It doesn't work in India, where the participation number is so low already that we can't wait for the customer to get to this point in the app to show him this detail, right? We have to provide that education up front in hopes that starts to break down some of those barriers of why customers aren't investing today. Switching gears a little bit here and looking at a different developing market, and this time Ghana. The team and I got to spend a lot of time in Ghana earlier this year, really digesting how does the local market work and what are customers looking for in this region. And I love looking at Ghana because it's so much of a smaller developing country than India. And there's some really unique differences in how that affects the local market and the local culture. In Ghana, one of the core challenges that financial service providers are running into is there's this real deep-rooted fear that if you as an investor put money into a stock, you go invest in a stock or maybe even a fund, that tomorrow you may never be able to get that money back, right? That's a major concern. And the reason why that is if you look at, for example, the stock market in Ghana, the local exchange, and I have a screenshot here actually from one of the trading sessions last week. I think this was on Thursday. There's about 37 companies that are publicly listed and traded in Ghana. But on this Thursday last week, only 4 of them ever exchanged hands. There were only 4 of those companies that one person bought and another person sold. And so if you're an investor in Ghana and maybe you're evaluating your options for starting to build your wealth and starting to invest, this is a real concern that, if you had bought any of those other 33 companies, you don't really have the confidence that you'll be able to sell that tomorrow. If you ultimately need that money back, if you have an expense that you need to pay, there just may be nobody on the other side wishing to buy that stock from you. And so with a market like Ghana, we really have to do two things. We have to, one, solve this liquidity problem, because that's going to increase the adoption and make it more and more accessible. So we have to bring products that don't have the same liquidity profile and are easy to exchange back and forth between fiat. And then two, we have to educate customers on how it's different. So we have to tell customers that if we're bringing, let's say we're bringing a US stock investing product where Ghanaians can invest in, large international names like Apple and Facebook, right? We need to educate them on how the risk profile of those assets may be different from what they're used to and their existing mindset, in order to get them to understand how, again, that risk profile can be dramatically different. And so in all three of these different regions here, what I find incredibly interesting about the space of investing is that all throughout this, we've been talking about what is under the hood a very similar product. We're talking about customers that are investing in stocks, investing in funds, maybe investing in some alternatives like crypto, right? But that same investment product, depending on where we're deploying it around the world and depending on who the audience is presented so dramatically different, right? In features, in marketing, in education. And so it's amazing how that one product can really sort of revolutionize in investing in so many different corners of the world by tweaking it to the local expectations and the local needs. If we look back at that timeline from before of how the US has developed investing products, and we talked about how we went from 20 years or so ago, digitizing finance, to getting more and more product choice, taking down those cost barriers, and now finally we're in this true age of the embedded investing solution. I think what we can actually do is we can take all the other countries that we talked about today, and honestly a whole lot more, and we can almost plot them on this like a sliding scale. And I think what you'll see is that all of these markets, and again, many more around the world, are very rapidly developing their investment programs and investment products towards this embedded solution or this embedded age that we are in here in the US. And, quite frankly, in a lot of these markets, that evolution is happening a lot faster than the 20 or so years it's taken here in the US. And I think as a team at DriveWealth, we're really, really excited to be part of what's making that revolution possible in so many different corners of the world. So if this has been interesting to you and you're interested about investing overall, visit our website, check out what we do, learn a little bit more, and we're happy to discuss how we can help support you in your next mission to bring investing to your customers or into as many markets as you're looking at around the world. Thanks so much.
John, that was a great presentation, and found it very insightful how sensitive the product and the experience is according to the local markets that you're attracting. One thing, we have time for one quick question, I guess.
Sure.
In the US, a lot of the rise of the Robin Hoods has sort of put us focus on how easy and how slick some of these apps have become, and they're starting to put sort of brakes on the gamification of that. How do you handle sort of that tension between providing education up front, but also helping make smooth experiences for people that do want to trade?
That's a really good question, and obviously something that we've seen some headlines recently about the SEC evaluating and really trying to understand. And I think ultimately what the world of finance is trying to discern is what is that balance between making somebody feel very positive about the experience and positive about the decisions that they're making, but not necessarily gamifying it, right? We don't want investors to come in and want to trade every single day because it feels good, right? We want them to do that because we want them to habitually invest because it's responsible for them, right? And we want them to invest every time they get a paycheck or every time they spend, right, in ways that are very passive. And so I think it's an open question sort of where that line is, but I think ultimately there's some really good examples out there already of what resonates with customers and how customers are reacting to different styles of interface. And it's something that if you're a product designer and you're looking at this space, it's something you can certainly test out with customers, right? As you develop new interfaces and new styles of working through those flows, how does that change how many customers are investing? How does it change how people go from never investing to finally invested, and what that percentage is? And how often are people investing? And all those things we can really look at tied to the UI and product decisions that we're making.
John, it's great having you join us. That was a great presentation, and thanks for joining us on the Big Bank Theory this year.
Thank you so much for having me, Zach. Take care.